Alright, guys, so today we're going to cover three big things that are going to change the world. Not just the global economy, but the world order as we know it. Now, two of them are disasters, but one of them is a piece of good news. So we aren't totally doom and gloom here. There's a rainbow every now and then. Let's start off with Zelensky because his trip to Washington was an abject failure. And I'll keep it simple here. He went there on a fundraising campaign for additional money, but he isn't going to get it at least in 2023. In our lead story today, Zelensky's US visit falls short as aid for war has stalled. Biden is warning of a Putin win. Zelensky wants to prove Russia wrong, but the end game is coming. We have reached a point where aid is drying up and there will be nothing for Ukraine until 2024, if it even comes at all. Biden has released another $200 million, but we all know it's a drop in the ocean. The battle alone will burn through that in a matter of weeks or even in a matter of days. The level of US opposition to Ukraine aid is growing fast. Over 30% of Americans today feel that the US is spending too much on the war. That's 4 times higher than in March 2022. We have said for quite a while now that the longer this war drags on, it'll be in Russia's favor. While America has the power of the US dollar, they can't borrow an endless amount of money to fund a forever war. It isn't good for the US economy, especially when everyone's banking on a soft landing today. War spending elevates borrowing costs for the wider US economy, and that crushes domestic consumption, it crushes domestic demand. But the military industrial complex isn't the real economy. It's money thrown into a black hole. It doesn't increase the productivity of the country, which is what you need to bring inflation down. You're not pumping out more oil from the ground, you're not investing money to new technology, you're simply making bombs to blow things up. The CPI numbers are out and it shows inflation in the US is still a persistent problem. Headline inflation has risen by 0.1%, but core inflation has risen by 0.3%, which is a big concern. So CPI now is at 3.1%, while core is still at 4%. What does this tell you about interest rates? It's not going to come down anytime soon. If the US continues to funnel money to Ukraine, this will drag the inflation fight longer and longer, and that will keep rates at over 5% for much longer. And if we look at Russia's economy, it is not collapsing. All the sanctions thrown at it perhaps slowed Moscow down a little, but the spaghetti isn't sticking on the wall. From Bloomberg, Russia's key economic sectors are shrugging off the sanctions. In Q3 this year, their economy has grown by 5.5%. That's higher than the Eurozone, the United States, and even China. Putin's also going to ramp up war spending in 2024. 30% of Russian government spending is directed towards the armed forces. It's basically a show hand move at the poker table. And if your cards are horrible, it's better to fold now than to lose everything. Remember that the US is an ocean away from Europe. They can insulate themselves away. So don't be surprised if America decides that enough is enough, because we could be reaching the breaking point soon. The US might be having a rare moment of clarity. And this development is freaking out the EU, right? The Eurozone is essentially in a state of panic. The moment America pulls away support, Europe can't possibly continue the war funding alone. They have to look after their own defense needs now instead of relying on Big Brother. The Eurozone is on the verge of another recession with Germany in big trouble. And it's not just the Germans, the Italians, the French, the Spanish, all their outputs are all showing declines. The entire Eurozone economy is contracting. Europe's lag effect of higher energy prices is finally starting to kick in. They have been decoupled from cheap Russian energy for far too long. The output in Europe's biggest economy fell by 0.4% in October, and that's 5 months of straight declines. If you have an economy that's crashing, there's no conceivable way you can keep funding Ukraine forever as well. And that's why the Europeans are about to make a horrible decision that will backfire like no other. They are about to push financial sanctions to the next level. Even America isn't crazy enough to cross this red line. We are of course talking about confiscating Russia's assets, and it's fast becoming official. Watch this carefully because they are about to launch a torpedo on their own financial sector. Brussels have drafted a plan to use the Russian assets for Ukraine, and the taxable proceeds could reach 15 billion euros over the next 4 years. So around 4 billion euros a year for Ukraine. It's going to happen sooner or later. Von der Leyen, Janet Yellen, and even David Cameron are all behind it. Plus, now we have the Americans wavering in their support for Ukraine. This is triggering a knee-jerk reaction for the EU to confiscate the Russian reserves. So it's a 3-step plan here. Number 1, identify the reserves to target. Number 2, tax the frozen assets. And number 3, transfer the money to the EU's budget, after which the money then goes to Ukraine. The problem here is the justification. It is on extremely shaky ground. Just listen to this. The returns generated by the frozen assets are not due to Russia, nor are they Russia's property, because they are distinct from the principal immobilized assets themselves. It's like saying that the interest earned in your bank account is not your property. It belongs to the bank or the state. And if that's the case, what's the point of investing or depositing your money? It's such a ridiculous plan that even the IMF believes that it's a bad idea. It's even worse than the commodity sanctions. You are using the assets of a sovereign country without permission. Any confiscation or loss or misuse of these assets or undue appropriation of revenues could impact financial stability and the functioning of financial markets globally. In other words, the Western financial system will get wrecked. The world, especially the global south, will pull their money away from Europe and even the US as well. So stay tuned for more updates on this, because come 2024, the EU will be opening Pandora's box once again. And speaking of disasters, Argentina just suffered a major collapse in their currency. Milei has devalued the Argentine peso, causing it to fall by incredible 54% overnight. And because the currency is still overvalued, it will continue to collapse by 2% every month going forward. This is, of course, a tragedy to the man on the street, right? Can you just imagine waking up and realizing that your savings are now effectively cut by half? And let's understand what happened. This is a form of inflation where your currency weakens versus the dollar. And because everything in the world is still priced in dollars, your buying power effectively collapses. The official exchange rate today is 800 pesos per dollar. Before the announcement, it was around 366 per dollar. And this forced inflation by government decree is only going to get worse going forward. So if it cost you 500 pesos to buy a loaf of bread yesterday, after the devaluation, you have to pay over 1,000 now. That's double the price overnight. Now, this was baked into the cake, right? Milei, he had to devalue the currency because he just doesn't have enough dollars in the reserves. He can't artificially maintain a higher exchange rate forever, so the Argentine peso sooner or later had to collapse to its true value. The biggest losers of this are, of course, the savers and the bondholders. And I want to talk a bit about the biggest risk to bonds. We know the nightmare scenario is the default, right? You loan money to the government and then they refuse to pay you back. But the biggest threat here is actually inflation. When you have a sudden devaluation of 54% on top of a 140% inflation rate, that's essentially a currency collapse. If you're a saver or you bought government bonds in pesos, you are screwed. Your savings have been inflated away. There's no other way to say this. In addition to the currency devaluation, Argentina is also moving to cut fiscal spending. The government will be slashing a lot of spending, equivalent to nearly 3% of their GDP. Now, this is extremely radical. That means a lot of government employees will be out of work. The real economy is going to take a brutal hit. Just imagine America shaving 3% off its GDP. That's an instant recession tomorrow, which is exactly what's going to happen to Argentina. The GDP for Q2 came in at negative 4.9%. Q3 will likely be negative as well, and with this fiscal cut, Q4 will collapse even further. Argentina is heading towards a period of extreme austerity. This means people will be losing jobs, and every dollar they spend today has to be targeted. This devaluation and period of economic pain is inevitable. If it didn't happen under Milei, it would have happened under someone else. And to get back on its feet, Argentina has to increase their exports dramatically. This is what Milei plans to do. He's moving to ditch agricultural export tariffs that could see output jump by more than 60% to as high as 25 million tons. The last time that happened was back in 2015. Lower taxation means that farmers are enticed to boost production. They need to get wheat exports back on track. Removing currency controls isn't enough. Sure, this seems like good news on the surface. By increasing exports, you increase your income. But if Argentina wants the highest possible selling price, they can't cut away China. Beijing imports a ton of wheat and soybeans. Yes, that means Milei needs to work with a communist country, a country that is a non-democracy. And if you can see the bigger picture, perhaps Argentina can survive. But if he follows the American playbook, then this is just another repeat of history. And speaking of reform, something big has happened in China. Not many people are talking about it yet, but I think we are moving towards a more stable Chinese economy. Ever since the property crisis with Evergrande and Country Garden, the West has been calling for China to inject stimulus. In other words, they want China to get further into debt and throw money at the problem. However, Beijing is defying those calls. They won't be going down the dark path of endless deficit spending. President Xi disappoints investors by skipping signal for big stimulus. Everyone's thinking that China is going to flood the market with a huge amount of money, but that isn't the case. It's obvious that Xi Jinping is playing the long game here. He's admitting that there's a demand problem in China and he wants to develop their strategic sectors. The game here is to build up their modern industries. We need to look at the headwinds that China is facing. The property sector accounts for 30% of their GDP. There's a huge reliance that isn't sustainable in the long run. Beijing is trying to keep its budget deficit down. Their 2023 budget deficit is rising towards 4%, which isn't good. The US deficit, in contrast, is well above 6%, which is pushing America closer and closer towards default. China can't afford to have massive deficits. It puts their economy at a bigger risk of a collapse, especially when the West is trying to decouple with them. We have the US throwing tax sanctions on them, while Europe is moving to the risk to decouple and cut down trade with Beijing. So the only option left is to invest back into the country to boost domestic demand. So we're going to see a controlled implosion here. On one hand, China's real estate sector is going to drop further and further. The air is being let out of the balloon. China's real estate sector has been contracting for 8 out of 9 quarters. All of the excesses of the previous decades are starting to wind down now. Now, of course, if you're a property investor in China, you're going to get clobbered and the price should continue to fall further and further for a few more years. But we must consider the bigger picture here. China is now on a grand pivot towards a stronger domestic economy. I need to re-emphasize on China's big focus in 2024. It's all about industrial policy and technological innovation, basically building up China's manufacturing sector and the chip industry. Any spending will be channeled towards these sectors. There won't be any big stimulus coming for real estate. Over the past 20 years, China's growth has been fueled by investment money. Over 40% of China's GDP comes from total investment, which is bigger than domestic consumption. Well, this equation has to flip. Beijing has to boost household consumption from the bottom up, and this means building up the industrial base for sustainable growth. The only way to increase domestic consumption is to make the entire country richer as a whole by creating new jobs. Massive stimulus is just a stopgap measure. It will just zombify the economy. It will make Wall Street happy for sure, but this type of growth is built on a lie. So if you're investing in China, you must understand that Chinese stocks could continue to underperform for quite some time. If you throw in the decoupling narrative from the West, it's going to be hard for foreign capital to flow back into China. There have been more declines than growth over the last quarter in Chinese stocks, and we can expect the stock market to continue being under pressure for the next few quarters. But understand what's happening here. Beijing's new directive is to be more self-sufficient, and they are preparing for the worst case scenario, a world of decoupling from the West. And if their bet pays off, China's economy will overtake the US in the years ahead. Using GDP as the only measure of growth, then yes, America is ahead of China. However, in other measures, China has already overtaken the race. In a piece from the FT, we get two measures that show China has already won. They have already caught up. Using GDP based on purchasing power parity, PPP, China overtook the US long ago in 2017. That's 6 years ago. This is a more accurate measure of a country's production because it takes into account exchange rates. In other words, China has more productive output than the US. Electricity generation is another measure that confirms these data. We can see China's energy generation skyrocket to the moon since 2010, while the US has stagnated for the last decade. An economy that's growing naturally uses more energy to power its industries. So measures on the ground shows that Chinese economy isn't really collapsing, but they are growing well in real terms. And that's why China's reform is now angering the West. We'll continue to see more economic decoupling happening, and this is just the beginning. But let me know what you think in the comments below. Will Ukraine get more funding from the US? Or will China's economic pivot actually work? Let me know in the comments below. Stay safe, be sure to press the like button and subscribe as we navigate through these crazy times.